this video, we're demonstrating the market data spreadsheet and showing you how to calculate a dollars per square foot average for any neighborhood that you're doing market research on. The first step that you have to do to become familiar with the deals in a particular area is to do the market data research on that area so that you can know what the prices are, what the values are, and for certain reasons I prefer to break that down to a dollars per square foot basis rather than going by appraised value. Appraisals can be rather arbitrary, and the adjustments that are made for things like a garage versus no garage, basement versus no basement, finished room versus no finished room, things like that get rather arbitrary. I have discovered over the past few years that it's a much more consistent method to break these values down to a dollars per square foot basis. So what we're doing in this spreadsheet is we are assessing a neighborhood for rental and owner-occupant activity. We are then entering our lead data for our particular leads that we might have generated in a given area or leads that we may generate in the future. And we're going to use that information to help us determine what our maximum allowable offer would be. In this particular example, I've chosen a neighborhood that I'm familiar with called Norton Park. It's located in Smyrna, Georgia, and I've noted the zip code, and there's plenty of room here if I want to write out any other particular information. I've noted in my area makeup that this neighborhood is about 70% owner-occupied with about 25 to 30% rentals. I would consider this to be an entry-level neighborhood based on the pricing and the quality of the homes. In this next section, owner-occupant versus renters, and exit strategy, I've attempted to tie a little reference together for you. This is already entered in the spreadsheet, and it mentions that if the neighborhood is less than 50% owner-occupied, it simply means that this area is most likely best suited for rental property, wholesale deals potentially, and an occasional lease purchase. If we've got 50 to 75% owner-occupied, then we're better suited we can still do a lease option in most any area if we have a willing buyer and we're willing to finance on that basis. We could also do a discounted retail in an area where there are more owner-occupants than renters. But we couldn't expect to get full price if there's not enough owner-occupants in the area to make it really strong. And then, of course, any other strategy that might work given the specific circumstances of the deal. When we have 75% or more owner-occupied, we're looking at hopefully full price retail, a lease purchase if we want to sell that way, and any other strategy, again, that makes sense. But this is just intended as a general guideline to give you some basis for how to break down a neighborhood when you're evaluating that neighborhood. I've also noted in my notes here, and I've typed this in, this is mostly brick ranches built in the early 1960s. Now below, I've got my sales data, which I've already entered in the form, including the address. These are comparable sales in the neighborhood that are the most recent possible sales that I could find, and I've acquired these by looking at certain links and tools that are included in the program for referencing sales data. I may have talked to some neighbors. I may have just been farming this neighborhood, driving this neighborhood for some time, and so I know what some of these prices are purely from working the neighborhood. However, I've acquired this sales data. I might also have a realtor pull this data for me. But however I've acquired it, I enter it into my spreadsheet, and along with the sales price, the square footage, and then I've come up with a dollars per square foot average for each property, which the spreadsheet calculates automatically. Now, let's talk about a few little things to do with bringing properties into a spreadsheet like this. As you can see, the first three properties have a relatively consistent average that's in the low to mid 80s per square foot. Then we see that sales comparable number 4 has a rather high dollars per square foot average relative to the first three, and sales comparable number 5 has a low dollars per square foot average relative to the first three. Now, I've noted here, I put these in this way specifically because I want to call your attention to a couple of things. When you're looking at comparable sales data, you want to see numbers that are as consistent as possible, as we see here in our first three entries. However, entry number 4 is abnormally high compared to the rest of the properties in this neighborhood. And so what that may tell me is I've put a note down here at the bottom of my sheet that notes that this may be a possible fraud, because anytime you see something that's abnormally high relative to the rest of a neighborhood in your sales data, it could in fact have been a fraudulent deal, and it'll still show up in the sales record as a recorded sale. But you will have to take note of that when it looks abnormal like this, and either go check that property out and verify that it really is worth this much more money than anything else you've seen in the neighborhood, or you may want to just throw it out. When I'm looking at averages, I like to throw out, just like with the Olympic scoring system, I throw out the high and the low and take what's in the middle as my averages. So in this case, I might discard this property altogether if I don't feel good about it. And in the last one, 112 North Street, you see that the price is abnormally low relative to the other properties at only $39 a square foot. And I've noted here that that must have been sold as is. And of course I want to drive, if I'm not familiar with these properties, the first thing I need to do is drive out and look at these comparables and see what they really do look like. If they're vacant, if I get out there and this one turns out to be vacant, it very well could have been a fraud deal. I would expect to see this one be an as-is property that might have been sold by an investor to another investor as is, with the intentions that they're going to fix it up, which would explain the lower dollar price. In any case, I want to look for consistency among my sales data and look for a consistent dollars per square foot average, as we see in these first three examples. Moving on down the page, we take our sales comparables that we've got up here, and we'll note that the spreadsheet has calculated an average dollars per square foot. Now, it just so happens that even with these two entries on the end, the abnormally high and the abnormally low, we still come up with a good solid dollars per square foot average based on, again, that is consistent with our first three comparables. So in this case, I'm okay with that because I'm seeing a level of consistency that I feel comfortable with. The only thing I might want to do here is take note that the highest of these consistent dollars per square foot averages occurred back in the summer of '05. That's a pretty good ways back, so I might want to adjust this average downward slightly, but again, that's totally up to me. And you'll notice that if I take out the ones that I think are abnormally high and just simply blank those out so that they're not included in the calculations, then I've got a little bit more of an adjusted average, which of course is not a big difference, but nonetheless it makes my estimate a little bit more conservative and much more in keeping with my first three properties here. So I want to see consistency. That's the main thing. I want to have a good feel for exactly what an average per square foot value is in a given neighborhood. And one of the ways to do that and to be comfortable with it is to look for consistency. Once I've got an average that I'm happy with, if I have leads in that neighborhood that I want to go ahead and evaluate, or when I have them, whenever they come up, I'm going to enter them in the bottom of the spreadsheet and show their square footage. And again, this is, people say, how do I get the square footage? Sometimes it's going to be in the tax record. It may or may not be accurate there. One of the best ways to get square footage for your property leads is simply to ask the seller. When you use the lead evaluation form, which you'll see later on in the program, you'll find that this is one of the key questions that you want to ask. You simply get the square footage from the seller and incorporate that into your calculations. Now what I've done here is, let's just say that these are 3 leads that I've generated either by my own marketing efforts, a seller calling me, I found them, whatever the case might be, and I have discovered through speaking with the seller that what the square footage is of each of these properties. Now once I enter that square footage, it calculates over on the right hand side and shows me what my estimated after repair value will be. For example, let's say that turned out to be 1,500 square feet, then it would recalculate my total, as you can see right here. So what you're doing is when you enter the square footage for the property, it automatically pulls your average dollars per square foot up here, takes the square footage for your property lead, and calculates an estimated after repair value based on that square foot average. So if this house were 1,800 square feet, my ARV would be adjusted to 150,115. So that's how the basic market data spreadsheet works. You come up with an average for a particular neighborhood based on sales data that you've collected, and then when you enter your leads and the square footage for your leads, it automatically gives you an estimated after repair value based on the dollars per square foot averages for that neighborhood. Now this is your foundational number in your formula, so it's very important to be as accurate as possible with the dollars per square foot average so that your after repair value estimates are accurate, because their after repair value is the basis from which all of your other numbers will function. And if it's the basis, the foundation of the formula that you will use to come up with the maximum allowable offer. So it's critical that this number be rather conservative and as accurate as possible.